Great loan and skip the bank when you do. More and more people make it happen by taking advantage of what's called peer-to-peer lending. Certified Financial Planner Gary Abley joins us now to talk more about it. This is kind of one of those buzz phrases that's going around in the financial world right now. What exactly is peer-to-peer lending, though?
Well, it is a buzzword right now, and it's also known as P2P. Of course, we have to have acronyms for
exactly.
everything. Right? But in essence, it's an online marketplace where borrowers and lenders can meet up. And say you want to put a pool in your backyard.
Okay.
You can go online and say, I want to borrow $25,000. You don't have to dress up in a suit and go to the bank. You just put in your information. An intermediary will say, Tom's a pretty good guy, probably has a great credit score, had a degree, went to college, etc. And then there are other people on the other side who will say, I'm willing to loan Tom. Now, they may not loan you all of the amount for the pool. They may be willing to loan you $25, $50, $100, etc. So it's really just a marketplace online where borrowers and lenders can meet up.
All right, so what are the benefits of it? Let's start with that.
Well, the benefits, there are really quite a bit of benefits for both the borrower and the lender. So the borrower can get lower interest rates than they might otherwise get at a bank. They may be able to consolidate credit card debt. So for example, if you have credit card debts at 18 to 21%, but you have a high credit score, you may be able to get a low interest rate from one of the peer-to-peer lending companies. Maybe get your rate down to 10%.
Okay, all right.
Now, on the other hand, the lender may be able to get a better rate of return on their investment than what they're getting on corporate bonds or government bonds. But it's really important to note on the lending side that these are unsecured loans, and the lending period is typically 3 to 5 years.
Okay.
So this is not a liquid investment by any stretch.
It's not a quick turn.
No, it's not.
All right,
no.
So those are the benefits.
Right.
What are the risks?
Well, the risks, ironically, for the borrower, sometimes people really don't shop what all of their options are. So for example, if they're a very high, have a very high credit score and they do have collateral, they may actually do better off at a bank and get a better interest rate. But really the cons are greater with the lender. And the reason for that is, again, it's an illiquid investment and you have default risk. So your investment, the only rate of return you can get on your investment is the interest rate. But yet you could loan money to somebody that defaults on it and lose all of your investment.
And it's gone. And it's not gone. Like it's backed by anybody, any kind of federal insurance or anything like that. I mean, it's gone.
No, it's completely unsecure.
So I don't know if there's a way to answer this next one, but do you recommend it? Can you recommend it?
Well, I recommend it for maybe a small portion of somebody's portfolio that would be deemed high risk.
Okay.
Maybe what would take place of their high yield corporate bonds. They might get a better return, but only if they're willing to diversify. For example, don't loan Tom $25,000 for his pool, but maybe loan Tom $25 for his pool.
Okay.
And then loan Mary, $25 for her to consolidate her credit card debt, and loan Roger $25 for, his particular loan purpose. If you spread out the risks, it's similar to buying a mutual fund.
Well, that's what I was just about to say. It's very similar to diversifying your portfolio when you invest.
It is. One big risk, though, these are relatively new. The peer-to-peer lending really started out in the mid-2000s, and so it hasn't been tested in a long-term recession. So we could see a situation where the default really rises precipitously when we have a downturn in the economy.
Did this grow out of crowdfunding? Because it sounds a lot like crowdfunding.
It's very similar, yes. And it's basically getting everybody together that wants to save money on both sides. You have somebody wanting to earn a little bit more, somebody wanting to save a little bit, and you're able to have these intermediaries. There are two large ones in play right now, Lending Club and Prosper.
So when this happens, real quick, is there a contract involved, and do you need to look for that?
Well, you do, and there is a contract, but again, these are recourse loans. They are IOUs.
Okay.
But you don't have a lot of recourse, right?
Right.
Because there's no collateral.
It's very different than the traditional ways of going through a bank or
That's
something
right.
like that.
Somebody could go to collections, and that's about it.
All right, so here's the easiest one for you. Where do people find you if they want to talk to you?
They can go to financialgroup.com and click on any of those, and we have some great workshops if people want to get educated on these matters.
Gary Abley, thanks a lot. Appreciate your time this morning.
Thank you, Tom.
It is 8:20.